So the market can do really wild and crazy things, but eventually there's an underlying gravitational pull back to reasonableness. And just because somebody bids up the price of whether it's Tesla or Apple for whatever reason, because they like it, because there's a stock split or whatever, kind of nonsensical reason that they can come up with, over time, this stuff is going to average out and the pendulum is going to swing back the other way.
Welcome to Retire Smarter with Kevin Kroskey. Find answers to your toughest questions and get educated about the financial world. It's time to retire smarter.
It's another Retire Smarter podcast. Walter Storholt here alongside Kevin Kroskey, President and Wealth Advisor at True Wealth Design, serving you throughout Northeast Ohio and Southwest Florida. You can find us online by going to truewealthdesign.com. Listen to past episodes of the podcast, find subscription links, ask Kevin a question. Lots of great information there on the site. Again, it's truewealthdesign.com. We've got a great show for you today. We're going to be talking about the tale of 2 decades that we have now completed in the 2000s, and going to kind of look back at the last 2 decades and kind of very different decades as we look in the rearview mirror a little bit. But before we get to all of that, Kevin, what's going on in your world?
It never seems like a dull day or dull week, Walter, but so we have new family members. We have four-legged variety.
Oh, very nice.
I've mentioned in the past, a lot of our clients know that my wife and I, before we had two-legged young family members, aka children, we had 4, and we had 2 Old English sheepdogs that had 4 legs each, not in total.
Thank you for clarifying.
Just wanted to point that out. And unfortunately, in the last year, we lost both of them. They were 12 and 14, and so my wife is on Facebook and on a rescue site and sees this dog, and it looks exactly like our most beloved dog that we lost. And it just uncanny how much this dog looked like our Boogie. Was his nickname that he grew into. Bear was his Sir Pickwick Bear of Royalton was his given dog name.
Wow.
Yes. Well, you know how it is. You got to be a little pretentious when you're into dogs, I think. So, but Boogie
depends on the kind of dog. Yeah.
Yeah, and the people, right? So she sees this dog, looks like our Boogie, and she thought it was our Boogie. She thought Facebook was showing her like an old picture of our Boogie, and here it's not. And then it's a rescue. Oh my gosh, this dog looks just like our Boogie, and so it kind of got the wheels in motion. But here the dog was actually a rescue in South Korea. So we had an Old English sheepdog that is in South Korea, and I don't know if you know this, Walter, but when you go into China and some of these Asian cultures, it's men will eat dogs to supposedly enhance their virility, and so they have this dog meat trade, and I think China is maybe the worst, but South Korea, it's prevalent as well, and so
that was in the news a lot at the beginning of the COVID crisis. I remember seeing a lot of those articles.
Okay. Yeah, so my wife kind of informs me on some of this, but basically once she saw the connection with our Boogie, I mean, just the wheels started in motion, and then oh, by the way, there's another purebred Old English sheepdog, and his name is Moby, and so basically last week I picked up these 2 sheepdogs that were shipped here from South Korea, and whoa. What's interesting is we were watching these videos and they're responding to South Korean commands. One is 1 year old and the other one is 2. And I'm like, great, we have Old English sheepdogs that aren't English, that are from South Korea, that respond to Korean commands, and now they're coming back, to the States to learn a different form of English. And Walter, all I can say
and
to
they
that
eat kimchi instead of dog food.
Well, so the guy at the airport, when I was picking him up from cargo, he's like, "Oh, you saved him from becoming chop suey, huh?"
Oh my god!
I'm like, "Oh, great." But yeah, so our life is busy. They are great dogs. I mean, we thought we were going to have some, our work cut out for us, just being that they were rescues, and their temperaments are fantastic, which is really great for us, being that we have 2 young girls. Certainly have to learn and go through training, but life got busy. But it's definitely seems like it just feels more fulfilling again. It feels more natural for us. So that's what's going on in the Kroskey household.
Something about having a dog in the house that just makes the world better. I think that's definitely true. A lot of people can identify with that for sure. I'm curious, have the dogs found it difficult, the culture change from South Korea to South Florida? They're so sophisticated, I thought they might have an opinion.
Not that I can tell. Moving right along.
Thanks for letting me pick on you a little bit.
It's all good. It's all good.
Do we have names yet? I realize we're within the week, so you may still be formulating that, eight word name.
Yeah, we're keeping Moby on the one, and for the one that looks like Boogie. We were thinking maybe BJ, Boogie Jr. We were thinking, I don't know, there's a few in contention, but right now we're just like, hey, you, which is really effective for training.
Dog 1 and Dog 2.
Yeah, so I think we're kind of narrowing in on it, but we have not firmly decided. So trainer is coming over this week, and we have to have a name picked by the time the trainer's here.
All right. Well, we'll get a report from you next episode on what names we ended up with. But good for you. Glad that dogs are back in the house. They are amazing. So I'm glad that brought some light into the Kroski household this week, and will for many years to come, it sounds like. Well, speaking of bringing light into the household, this is a very poor segue, but we'll try to bring some light to the financial conversation on today's show. We're going to talk about the tale of 2 decades. We're a little over 20 years now into this new decade, or just below the 20 years, depending on where you mark the millennium, I suppose. But in any event, about 20 years of data to gather and talk about these last 2 decades, Kevin, and a little bit different course of action between the 2 decades, different way of kind of putting them into context.
Yeah, and the purpose of this, I think it's going to be instructive prospectively. It's not just kind of a historical redux on what happened over the last 2 decades. I've had several conversations over the last couple of weeks with some friends, some neighbors, some new clients that are coming aboard, and just kind of, it just feels different. I wasn't I was still in college in the late 1990s when the tech bubble was kind of going, and I was not a participant from the professional side, but more so from the observer and losing the little bit of money that I had, as I thought you could not lose in tech stocks, and swiftly learning that yes, you can certainly lose, and things do swing the other way. But it feels like that. I had a neighbor that has a Tesla, asking me, hey, I was on this, Schwab website, and I got this, account. I can't figure out how to go ahead and buy $50,000 of Tesla. I'm like, whoa, like if you can't figure that out, should you really be putting 50 grand into it? I didn't say that, but you probably saw it on my face. And, so I had that. I mean, I've had a few people recently where, they're just, hey, they've done really well in their portfolios. And candidly, I mean, after kind of talking with them, I'm like, well, how did you pick this? He's like, well, it's been going up a lot. And usually, I mean, the investing process of it's been going up a lot, so I'm going to buy it and hope that it's going to keep going up tends not to work out that well. But it has been working recently, and it's been working quite well for a lot of people that are, chasing shares of whether it's Tesla, Netflix, any of the tech stocks. We've talked, a fair amount about it in different ways over the last, probably year or so, but particularly through COVID, because, it obviously had a big difference of impact, whether it was more technology enabled or not. And even today's the day that Tesla and Apple shares are doing a stock split. And so for anybody that's not sure what that means, just say that, hey, it's $1,000 a share, and they'll do a 2-for-1 split. So they're just going to say, well, we're going to make our shares worth 500 rather than 1,000, but we're going to give you 2 of them. And so, Walter, what would you rather have, $1,000 or 2 $500 bills?
I will take whatever you want to give me.
Mathematically, it's equivalent, right?
That's right.
Well, I mean,
whatever's easier for you would be my response to that.
The mathematical equivalency is very rational, and and that's not what's happening in the market. So apparently, the stock split is saying, "Woohoo! We're getting more shares, so that must be good. So let's buy more of it." And the stock price is going up even higher when there's no really foundational reason for that to happen. In fact, I'd argue probably the opposite. That when you look at the Dow, the Dow has 30 companies in it, and Apple is one of those 30 companies. And not a lot of people know this, but they should, particularly if they're quoting the Dow or maybe buying an ETF that's based on the Dow. But the Dow was one of the first indices that were created. I think it was like in the late 1800s, very late 1800s or very early 1900s. And it's a price weighted index. And what that means is, whatever the share price of the stock is, in part just basically determines how much of it will be in the index. So when Apple is doing a stock split, it is now going to be less in terms of the composition of the Dow. So any investments, index-based investments that follow the Dow, which there are many, I don't know what the dollars are, but it's quite substantial. It's a very common index that's out there. Those index providers have to sell Apple today because the stock split has lowered its stock price and thus lowered its composition in the Dow. Makes no rational sense, but it was kind of the first index that was created, and it basically has never been fixed. It's just kind of the way that it is, the way that it works. And so because those index providers have to sell it, I would say that, well, hey, if anything, there's more of a technical reason why Apple should not be going up, but yet it seems to be. So, again, two $500 bills, or I don't even know if there's $500 bills, but let's pretend that there are, is the same as a $1,000 bill, which I know there was. I don't know if they still exist or not, but you get the gist. Whether it's 5 or 10 or 500 or 1,000, two of the fives equal one of the 10. Let's put it that way. So
no longer in circulation, the $500 bill.
Okay. Thank you. So you have a lot of this frothiness going on.
McKinley, by the way, was on the $500 bill.
Okay. And what years was he in office, Walter?
That would have been 19...
Hold on. You're trying to recall it from what part of your brain? Oh, the Google part of your brain.
From the Wikipedia part of my brain. Thanks for catching me on that one.
So you have my neighbor that's trying to figure out how to buy $50,000 worth of Tesla and can't figure it out. But if you can't figure that out, certainly Tesla's got to be a good buy. So the buy makes sense. You have people that are just kind of chasing returns here, and things are just going up. It seems like just because. We talked about Hertz, and like Hertz had they're in bankruptcy and their debt is trading for pennies on the dollar, but yet their stock price is substantially higher. In fact, they were trying to issue new shares of stock because there was a market for their stock. They're like, this makes no sense, but hey, let's capitalize on this idiocy and let's issue new shares. And then the SEC came in and said, no, you can't do that. Yes, people are dumb. They didn't say that, but basically that's what they were saying. And we are going to protect the dumb people from being even more dumb, or dumber, I guess I should say. So you see a lot of, it's not like the market is completely irrational right now. I would say certain parts of the market certainly are, certain stocks certainly are. We talked about this with Zoom, and there's a different company that has the Zoom ticker versus, the Zoom that people are doing the web meetings on. And people didn't even know what they were buying. So they're just buying the ticker Zoom and send it up like 140%. And then they're like, gosh. Oh no, it's the wrong company. Oops. You just have a lot of craziness going on. So it feels like, again, I wasn't in the business in the late 1990s, but that tech bubble is kind of what drew me into it, because I just had an interest for that. And I really wasn't all that happy being a high school physics teacher. But I digress. And it feels like that right now. It feels like, hey, I own a Tesla, so I like it. And so the stock has to be a good buy. And hey, I'm on this computer and it has Microsoft on it, and Microsoft has been going up, so that's got to be a good buy. And there's, price or value really never come into play. It's just like, it's going up, let's buy it, and it's going to keep going up.
That was the mentality I grew up with my grandmother was getting me into finances at a young age. My cousins and I were very fortunate to have her influence over the years. I've told her story before on the podcast, but that was part of her reasoning for buying the stocks she did. Was one, she was looking for dividend-paying stocks was one thing she always prioritized, and just strong companies that had been around for a long time. But then the third one was something that we'd be interested in as kids. And honestly, that was one of the big driving forces, which is why we had some Disney and Hershey and Harley Davidson and, cool, fun stuff for kids. And then one year we got Energy. We were all like, what is this? what is this, Royal Energy Group of Scotland, or whatever it was.
Where was that show?
That's right. But it's interesting because it's funny because then it's hard to shake that when you grow up learning something a certain way. It's hard to get more sophisticated on the topic once it becomes part of your mindset.
I think that's true, but also the way that our brains work. I mean, one, you should know what you're investing in for sure. You should understand it, but you shouldn't just buy something because you know it. That should be the other very important part of that sentence. Make that point about a compound sentence. Yeah, know what you invest in, but make sure you buy it at a decent price. Something to that effect. And, all these companies people certainly are hearing about and know, and, I have an Apple device and, certainly, enjoy, utilizing it. But, just because it's a good company doesn't mean that you're actually getting a good price or going to get a good return, from owning the stock. You can pay too much. I always use the analogy of a house. You and your neighbor have very similar houses. Say you bought yours for $400,000 earlier this year, and then the neighbor sells theirs for $500,000. 6 months later, they got a great house, great neighborhood, but they way overpaid for the house. Same thing can go for a stock. So you just kind of have to look through this. But I think looking back over this tale of 2 decades is instructive because again, it feels like right now what the late 1990s felt like. And certainly the 1990s with the tech bubble was just booming, and U.S. stocks, particularly technology stocks, were just kind of shooting the moon. And then, when 2000 came around, things just kind of flipped and went the other way. And it was really March of 2000 when it started going the other direction. But really through all the 90s, I mean, it was just going and keep going. And it was irrational exuberance was kind of the term that you heard. But it even kept going after it kind of got into nosebleed prices. But when the music ran out, and people were looking for chairs to sit down, they realized, oh man, price does matter, and there's no chairs for me to sit in. And if you held on to, say, the NASDAQ, as most people know, is generally technology focused stocks. The vast majority of it is really comprised of a lot of these large tech companies, the Amazons, Apples, Microsoft, Google, aka Alphabet, and Facebook as well. But when you looked at what the NASDAQ did from January 2000 through December of 2009, it lost an annualized average of 5.2% per year. Cumulatively over that entire 10 years, what that means is if you had $1 million in the NASDAQ in January 1, 2020, by December 31st, 2009, you had about $590,000. $1 million down to 590, entire 10-year period. So, those were still some great companies. Microsoft was in there. Microsoft was a great company. Cisco was in there. Cisco is still a great company. Intel, all these companies were still in there, and they were in the NASDAQ. They still are there today, and they're still great companies today. It's just that you paid way too much for them, in the late 1990s, and you paid for that over the next decade. Even if you looked a little bit more broadly and went outside of just more the tech-focused NASDAQ and looked at the S&P 500, even there for that entire 10 years from January of 2000 through December of 2009, you lost about 1% per year, or you lost, again, if you had $1 million in the S&P 500 in January 1 of 2000 and you looked at the end of 2009, you had about $900,000. So you lost money for an entire decade. It's just amazing to me right now. And it shouldn't be. I mean, I know investors can kind of be led astray by what we call recency bias and this familiarity bias. And hey, we know these stocks and look how well they're doing, so this is going to keep happening. We talked about Homer Simpson in a couple of podcast episodes ago, how his investing thesis was, hey, it's October. These pumpkin prices just keep going up. I'm just going to buy it. It's just got to keep going up and up and up. And obviously when you get through October or November, you realize that it doesn't really work anymore. You're having that happen right now. Now, what hasn't been working as well more recently are smaller companies or international companies, whether they're more developed economies like Europe, Japan, the UK, Australia, or even more emerging economies like China and India are two of the larger ones. If we look at, say, the last, let's go back to the 2000s. I'll go back to the 2000s first, since we already talked about that time period. So where the NASDAQ lost 5.2% per year, and the S&P 500 lost about 1% per year. If you went to emerging markets, they actually made more than 10% per year. So 10% per year, you just do some simple math there, and your money way more than doubled over that 10-year period. If you go to international small companies, about 13% here per year, not cumulatively, 13% per year. So here your money is more than doubling, almost 4 times as much over that time period. And so the U.S. was really out of favor because it had done so well during the 90s, been bid up in price, still had these great companies, particularly these technology companies. Some of them went away, but a lot of them were still there. Microsoft, Intel, Cisco, again, you name it. But you paid too high of a price and you had negative returns for an entire decade. Meanwhile, over that same time period, you had small companies in the U.S. that were doing well, about 8% per year. You had the emerging markets, like I mentioned, 10% plus per year. You had international small companies doing more than 13% per year. So that's really where you made the money through that decade, owning small companies in the U.S., owning some value stocks in the U.S., and then owning international stocks as well. Now you fast forward to, say, the last 10 years, the 2010s, which, here we are from January 2010 through December of 2019. And as everybody is well aware, the U.S. market has been, kicking butt recently. You look at the S&P 500 over those 10 years, 13.5, 13.6% per year. You look at the NASDAQ, more than 16% per year over that time period. And then you go on the other side of it and, small companies in the U.S. still did well, about around 12 or so, but you go international and here you are and looking at, say, emerging markets and you're closer to about 4% per year. Or you're looking at international small companies and you're around 7. Not terrible. And you didn't lose a lot of money like you did owning the NASDAQ or the S&P 500 in the prior decade. But certainly that's, if you look at it on paper and say, man, I'd much rather have a 16% return than a 4% return. I mean, you don't have to be a financial advisor to figure that one out. But when you put this all together, if we just string the entirety of these 2 decades together, the 2000s from January 2000 all the way through the end of December 2019, so 20 years in total, and now you look at the returns. So you had, these 2 very distinct decades, but now you put them together. And now you look at the NASDAQ and it had about a 5% per year return. You look at the S&P 500, it had about a 6% per year return. You look at small U.S. stocks, hey, you actually got compensated for owning those even better. You made about 10% per year. You go outside of the U.S. and you look at emerging markets, here you got about 7% per year. So you got more than what you did for S&P 500 and what have you. You look at international small companies and here you got about 10%. So what I'm hoping people are taking away from this is that we all know that we need to be diversified, but diversification works when you want it to and also when you don't want it to. People love diversification during the 2000s when the S&P 500 lost money for an entire decade for 10 years. They loved it when the NASDAQ was down more than 40% over those 10 years. And now here more recently when those asset classes are doing really well, they hate it. Why do I own this international stuff? Don't you know America is the best country in the world to live? Guess what? It was the best place in the world to live 20 years ago too. But it was the exact wrong country to go ahead and invest all your money in. And we don't know what it's going to be going forward. The U.S. market has been really expensive for quite some time, but it's continued to get more expensive. At a certain point, I mean, we talked about this in the past too, kind of the forward-looking nature of the stock market relative to the economy. But then when does looking forward become more the irrational exuberance and you're really just overpaying? And nobody has the crystal ball. And certainly there's ways to go ahead and kind of measure this. But in the short term, whether you're talking about 6 months, a year, 2 years, I mean, anything can happen. That term irrational exuberance was created in a book that was written in 97 and published in 1998 by Robert Shiller, who is a professor at Yale and who later won a Nobel Prize. But the market was was irrationally exuberant and kept going up more than double digits for another 2-3 years from the time that he researched and wrote the book. So the market can do really wild and crazy things, but eventually there's an underlying gravitational pull back to reasonableness. Price does matter. What we get as investors is the earnings per share that we have. And, just because somebody bids up the price of whether it's Tesla or Apple for whatever reason, because they like it, because there's a stock split or whatever, kind of nonsensical reason that they can come up with. Over time, this stuff is going to average out and the pendulum is going to swing back the other way. I don't know when it's going to swing back, but eventually that music is going to run out. And if you're talking about investing your retirement dollars, particularly if you're in the last few years of working or those first few years of retirement, that's kind of the red zone area that we've heard about. Having really negative returns during that time period can really cause a lot of harm for you and your financial plan, and may cause you to have to work longer or spend less in retirement. And God forbid that you have to go back to work. But you got to be responsible here. You got to be prudent. You got to be diversified, and you have to take, more than a 6 or 12 or 24 month time frame. Again, we talked about decades here. I mean, beyond belief to me, how people just forget. It's like, all the things I'm hearing about American exceptionalism. I mean, it was the same thing 20 years ago, but it was just such a terrible place to invest. But it's like, it's only 20 years, but it's like people completely forget about it, Walter. Maybe that's why I in part have a job.
Recency bias. We all have it. And it's a value to be able to buck recency bias and put things in that grander scale, to see the future as, not just a year, but decades at a time, or hundreds of years at a time in some organizations.
Yeah, and most people, as it relates to the retirement planning, certainly they want to get a decent return on their money. They want to get a return commensurate with the risk they're taking. But more importantly, they want to make sure that they're able to preserve their lifestyle. They want to make sure that they don't have to go back to work, that they can sleep at night. All those, important things. That money is a tool. It's not the end all be all, but you have to get a good return. I mean, if you look at those 20-year returns that I talked about from 2000 to 2019, and you're looking at like 6% for large U.S. stocks and, 10% for small stocks, both U.S. as well as outside the U.S., and you're getting a little bit more for emerging markets over those 20-year period, that's about what you would expect. When you factor in just longer term expectations based on risk, based on growth of the economies, things along those lines. But you look at 10 years, and 10 years sounds like it sounds like a really long period, right? But in investing, it's really not. And I think that time frame is something that's difficult for a lot of people, because, they're going and not the recency bias is there, but they just think a year or 2 or 3 years is a long period of time. I mean, I had a conversation with a new client. We worked together on some project work in the past, and we just had a conversation again last week, and they're going to be coming on as kind of what I would call a full-blown client, where we're going to handle their planning, their taxes, and their investing. And, he's talking about, how his portfolio is doing well this year, and how another advisor that he hired, he didn't do all that well. And I just told him, I said, I have no idea how the next year is going to go. I mean, I'm very comfortable in our thinking and our process, but anything can happen in a year. And not to defend your advisor, I'm not sure what they're doing for you or didn't do for you at this point. But a year, frankly, is way too short to draw any meaningful conclusion. 10 years, like we just talked about here with this 2 different decades, is quite a long period of time to get 2 almost mirror opposite results. And you just look at it and say, wow. And I get it. It's 10 years is a long time, but when you look at investing, the markets can stay pretty irrational for a while and can get, really kind of bid up or kind of underperform for quite some time. But when you do take an even longer view, things do tend to even out over time. There is that underlying rational gravitational pull back to, we get earnings per share, and that's really what we get as investors. And so whether that's in the form of, kind of dividends being paid out, earnings per share being invested back in, that's what we get. And, if investors bid up or bid down a price of a stock, so something is maybe really exuberant or really kind of oversold, that's going to happen. Inevitably that happens in markets, because markets are constructed by people and people are emotional. But you need to have a little bit of longer term view. And importantly, you need to be diversified. You don't want to be chasing, money in something just because it's been going up. You don't want to be completely in the US. We've talked about episodes in the past where kind of pull different return expectations from a lot of different money management firms like JP Morgan, BlackRock, Morningstar, Vanguard. And every single one of them, I did this recently, again, for a client, every single one of them were expecting higher returns for international markets than the US. And I went back and I showed this client that this has basically been the belief for the vast majority of these large institutional money managers. I went back to 2013 and was seeing that pattern. And so here we are, kind of 7 years later, and they very sophisticated, very smart people, very good methodologies, but it hasn't been true. and they're looking at 5 or 10, or in like JP Morgan's case, 15-year expected returns. And so it could still be right over, say, maybe a 10 or 15-year period if the pendulum really swings back away from the U.S., but it hasn't been right so far. So it's natural that people start questioning this. But when you really understand investing and investing history, and you need to understand that, or you're going to repeat the mistakes that history could have taught you, and you're going to repeat them in the future. But 10 years isn't that much. We have to be diversified. We have to stick to diversification. Every time you look at your portfolio statement and you see something, you should probably have something that causes a little bit of angst. Maybe investment 1, 2, 3, and 4 are up, and then 5 and 6 are like, why do I own this? And they're out of favor for whatever reason. But when you put it all together, when you look at a diversified portfolio, the whole is more than the sum of the parts. And you want to go ahead and kind of smooth out that ride, reduce that wiggle factor, particularly when you're in retirement and taking out retirement distributions for your lifestyle, and just have a smoother return pattern, something where you can sleep at night, something where your money's going to last, and not really kind of chasing returns and maybe kind of ending up having to go back to work.
Couple of pieces of homework or things to clean up on the show. McKinley was president until 1901, to answer that question, when he was assassinated. So 1987 to 1901 was his distance. And lastly, in terms of catching up on notes, Grover Cleveland was on the $1,000 bill that you mentioned. And I'm a little disappointed that we still don't have that, because I just think that would be cool to call the $1,000 bill the Grover. Like, could you see, how much it costs? A couple Grovers. I guess that could catch on, I think.
Walter, that is like, that sounds pretty millennial of you. That is way hip. That's, who's the guy that's running for president? Kanye West hip. Kanye would probably say that, right?
Yeah, that's right. How much did that cost? How much did that car cost? About 20 Grovers. So I don't know. I'm going to start a movement. That's what I'm going to run for president on, that we bring back the $1,000 bill and we call it specifically the Grover. That'll be my platform. Wonderful to talk about these kinds of things and to get your perspective on them as always, Kevin. If you need some different perspectives when it comes to your financial plan, how you're preparing for retirement and beyond, don't hesitate to reach out to Kevin and the team at True Wealth Design. They can take a look at your current financial plan, talk about how they can design it heading into the future to accomplish more of your financial goals. Point out some of the areas where you may not know that pitfalls currently exist, some of the danger areas for your portfolio. It's a sophisticated, intelligent look at your financial plan. And again, if you want to set up a time to meet and talk with Kevin and the team about that, you can do that on truewealthdesign.com. Click on the Are We Right For You button to schedule your 15-minute call with an experienced advisor on the True Wealth team. Again, that's truewealthdesign.com, or give a call to 855-TWD-PLAN. That's 855-TWD-PLAN. Kevin, thanks for the help this week. Appreciate it, and enjoy those dogs, and we'll talk to you again next episode.
All right. Well, thank you, Grover.
Go make some Grovers, all right? We'll talk to you on the next episode. Thanks for listening today. For Kevin Kroski, I'm Walter Storholt. Don't forget to subscribe to the podcast on your favorite apps, and we'll look forward to talking to you next time on Retire Smarter.
Information provided is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accurateness and completeness cannot be guaranteed. All performance reference is historical and not an indication of future results. Benchmark indices are hypothetical and do not include any investment fees.